hablar precisamente de esto, de la Reserva Federal, del mercado, tenemos ya a Arnaud Mounier, jefe de desarrollo de negocios de renta fija en Alliance Bernstein. Arnaud, thank you so much for being in Negocios Televisión. It's a pleasure. Good afternoon.
Good afternoon. Thanks for having me.
After a pause in June, Arnaud, the market is pricing further rate hikes by the Federal Reserve. Is this also Alliancebernstein's view, and does that increase the risk of recession in the US?
Yeah, well, certainly we do agree with the market, and I think it's quite a consensual view that there will be a 25 basis point rate hike by the Fed in the coming days. It's certainly something that they've been telegraphing to the market, so not coming as a surprise. I don't think that should move the market significantly. The strong job market in the US give them the confidence that it's not a very high probability of a hard landing risk. And so I think this rate hike makes sense in a context where inflation is still very strong. So the second part of your question about the recession risk, again, I think such a strong job market in the US, very tight, gives enough spending power to US households. So give us confidence that the slowdown should not be too brutal. Actually, as a matter of fact, we have just increased our, I would say, growth forecast for 2023 based on the first half of the year, which was stronger than what we expected. So not much higher growth, kind of flat, but not a recession. And in 2024, we do forecast a small rebound in growth around 1%. So we know it's a risk, but it's not our best case scenario.
ECB showing no sign of pausing in interest rate hikes, likely to soon reach the historical highest level of interest rates since its creation. How do you navigate this environment in fixed income as a fixed income investor?
Yes, look, the ECB is going to rise their interest rates. I think it's also quite a consensual view. They are going to do so because inflation is going down, but not probably as fast as everybody wants. So the question we get from a lot of our clients, investors, are: should I stay short duration, wait and see until the rate hikes are done, or is it now a good time to extend duration in our fixed income portfolio? So the answer we are giving to our clients is short-term view is that since interest rates are likely to go up, probably to take a close to neutral view on European fixed income duration. And probably after the summer, we will start gradually increasing our duration. The main reason being that we think that growth in Europe will be definitely slower. Inflation should also normalize as we get closer to the end of the year. So for us, it should lead interest rates to go lower. The 10-year yield level should be probably lower than the level at which they are trading at the moment. So we will probably wait for a couple of months to increase duration, but eventually we think it makes sense to extend duration going into 2024 as the growth and inflation forecast for Europe are quite, I would say, low going into next year.
Favored higher quality bonds over high yields so far this year, Arnaud. Is that position that Alliance Bernstein shares?
Yeah, I mean, certainly, I think a lot of investors have been focusing on higher credit quality, been quite shying away from high yield bonds. So if the question is, do we prefer higher quality, safer investment at this juncture? The answer is definitely yes, especially valuations are not very provocative from a high yield perspective. If the question is, do we shy completely away from high yield and have no allocation? The answer is no. We still find pockets of opportunities in high yield, the double B part of the market, the shorter dated bond part of the market. They have some interesting opportunities there. But overall, we are not trying to have an overweight in high yield at this juncture. We think that when spreads are below 500 basis points, it gets a bit expensive. So that's something we want to be very selective with.
Any fixed income sector Alliance Bernstein has a cautious view on at this juncture?
Look, I think consistently with what I've just mentioned about high yield, we would avoid CCC rated bond at this juncture. I expect quite a lot of volatility there. We would avoid some securitized part of the market, like commercial mortgage-backed securities, obviously still under a lot of scrutiny after what we faced in the first quarter with the US regional banks, but also we see that basically commercial mortgages linked to offices, whether it's in Europe or in the US, is going to remain under the pressure. So those are sectors we are going to be quite cautious about. Emerging market is also somewhere where we remain quite cautious overall. We have seen some opportunities in local currency, EM markets, but it's really difficult to make a strong call for this asset class. So overall, emerging market remains a cautious allocation from us, not a strong call yet.
Arnaud Mounier, jefe de desarrollo de negocios de renta fija en Alliance Bernstein, muchísimas gracias. Thank you so much.
Thank you very much.